Welcome back to the Hunter of Dividends YouTube channel here. I'm going to take a look at a dividend growth stock that I think might be undervalued now, StarBucks Corporation, ticker symbol SBUX. StarBucks is one that I didn't really expect to be buying here over the last few weeks, but this one has really dropped to a level that I think for a long-term dividend growth investor, this is really turning into a good opportunity. First, we see here the chart of Starbucks for 1 year. Just kind of steady along for a long time. Hit its high there in July of 126. Then in late December, you're still at 117 about. And then the bottom just falls out. You see here the last 6 months, just a really nasty dip here for Starbucks. This hit its 52-week low here today as I record this on April 21st, 2022. Starbucks really long-term, the 5-year chart isn't really that impressive even now. At the beginning of the 5-year period, it was $63 or $64, and now we're $78.96. It's just kind of down from where it was even in 2019. So this is a Starbucks corporation that, to me, there isn't really anything wrong with what's going on with this company. It's just it was overvalued for a while, but I think the market's brought this back into a point of a fair valuation for long-term buyers. So let's take a look at some of the metrics for this one. Starbucks current price $78.96, current yield of 2.48. Morningstar rates this 4-star rated. Price target of 106, wide economic moat, and I don't think that one's even debatable at this point. I mean, everybody knows Starbucks has a lot of moat here. The company has a great business model. There's no doubt. People have been able to, they've been able to encourage people to come there and spend a lot of money on coffee and associated drinks there for quite a while, and I don't think that's changing anytime soon. In fact, I'm going to skip down and say, the strong recession past performance is something that really stands out to me. I'll jump back here in a minute, but I want to show you here recession sales between 2007 and 2009 were really, really strong for Starbucks. This is according to Simply Safe Dividends, much above average, much above what people expected them to have. It seems as if the consumer is fine with paying quite a bit for coffee. They would rather cut back on something else. As an investor, that's something I want to see, certainly. And Starbucks, Simply Safe Dividend score of 67, which is not an amazing rating, but it is safe. I think the dividend is covered pretty well here by the cash flow of this company. The 5-year dividend growth rate is 17%. That's excellent. You see here on the chart, Simply Safe Dividends, really impressive growth here on the dividend the last 10 years, 21%. So Starbucks, dividend.com says 12 consecutive years of hikes, strong recession past performance. Like I said, the payout ratio of 51%, not a really low payout ratio that I would expect massive dividend growth here, but I do think that they'll be able to continue to grow their dividend at least somewhat. Free cash flow payout ratio, 50%. The 126.32, the 52-week high. And really, that's only been 9 months ago. This has really come along here pretty quickly. Let's look at the Simply Safe Dividend numbers for this one as well. As far as timeliness, I think it's interesting when we see the 5-year average PE ratio, 28. If you look at the estimates now, the PE ratio right now, the current PE ratio would be 22.5. Now, that doesn't sound really low. But Starbucks trades at a high valuation consistently. It trades at a premium. It's kind of like a Costco, something like that, where it's always going to be highly rated by investors because it's a great business model. They can still grow a lot here in the future. I think there's plenty of growth to come. I'm not concerned about Starbucks, the company. The question is whether you're getting it at a good enough valuation. I think at this pullback, I am interested in grabbing a hold of Starbucks, and I've been buying this pretty consistently here over the last few weeks. You look at earnings per share, the growth is really impressive. Then you see 2020, obviously COVID that hit that significantly as we would expect, but the growth has come back really nicely since then. As far as other ratios that are kind of interesting, the net debt to capital is a bit higher. They do have quite a bit of debt. I don't love that. Starbucks is not going to be my biggest portfolio holding by any means, but I do think this is a good one at this price. Interest coverage, even with that kind of debt, 10.61, which is really not bad. Above 8 preferred for restaurants, according to Simply Safe Dividends, and the net debt to EBITDA is a pretty safe number. So restaurants can look a little bit different when it comes to these debt ratios. They always carry quite a bit of those. So in general, I think Starbucks is a good buy at this point for long-term investors. I'm not a financial advisor, so certainly consider your circumstances before investing here. I think Starbucks is one to look to if you're looking for a dividend growth name that will appreciate price-wise too in the long term. I think we're getting a really good price here on Starbucks. So SBUX is one I'll continue to add. I'll dollar cost average in. If it keeps dropping, that's fine with me. Dividend investors, we're buying future income. I'll be back to talk about some more stocks here coming up soon. Hope you guys are all having a great week, and subscribe to the channel below, give it a thumbs up, comment. Certainly appreciate those of you who have been watching these. Just trying to kick things off here with the YouTube channel and get a little bit more active. So I'll be putting more up here in the future. Hit the bell, thumbs up, subscribe to the channel. I appreciate it very much. Have a great rest of your week.